Celsius stock surged a massive 30% in a single day after the announcing acquisition of Alani NU. At first glance, it looks like investors are bullish on this deal, but there's something else we need to consider. 20% of the total shares outstanding in Celsius are shorted. The price surge could be that short sellers now have closed their position, leading to a price surge. But now we have also seen that the price of the Celsius stock has decreased back to $25. Hi everyone, and welcome back to the 50 or Nothing community. If you're new here, what I do, I analyze stocks using deep fundamental valuation methods to help investors like you make smarter decisions. Today we're focusing mainly on Celsius Holding, a stock that has outperformed the market in recent years, but is now trading at a premium after its latest acquisition. So here's the real question. Is the stock still a buy or has the market overreacted? In this video, I'll break down the valuation of Celsius using a Monte Carlo simulation and a discounted cash flow analysis. Let's see if there's still upside potential or if the stock is fairly valued. Let's break it all down. Before we dive into the valuation, let's quickly go over what Celsius does and why it has been growing that fast. Celsius is in the beverage industry and they sell energy drinks and they market themselves as a healthier alternative to traditional energy drinks. Like, they don't have any sugar in their drink in comparison to, for example, Monster has a lot of sugar. And they also have a strategic partnership with Pepsi. So Pepsi owns around 8.5% of Celsius, and they own that via preferred shares, which can be converted into common shares. And due to their strategic partnership, Pepsi is one of the largest customers of Celsius. So 50% of Celsius revenue is derived from Pepsi. And now in Q3, their growth turned from positive into negative, minus 31%. And they blame that on their largest customer, Pepsi, due to inventory optimization. Now, for me, I see that as a quite diplomatic way of saying that demand is decreasing for our products. Because, if Pepsi can't sell Celsius products, they won't buy any more Celsius products from Celsius. And now in Q4, we still see a negative growth. Could that then be the reason to why Celsius felt that we need to acquire another firm to at least keep the pace with the market and grow by 10% annually? So that's a quite interesting strategy. Like, you could grow organically by selling your product, or you can grow by acquisition. That is something I will dig deeper into and show you the pros and cons with these two different strategies. Before we dive into valuation, we need to get a sense of the profitability of the beverage industry. So what I've done here, I've collected 60 energy drink companies that are publicly traded. So here you don't have, for example, Red Bull, because Red Bull is not publicly traded firm. But here I have Monster included in this diagram. And here you have the profitability ratios. And on the left side, you have the deciles. So how you're going to interpret this diagram is that out of the 60 companies, the company with the lowest gross margin had a negative 81.2%, whereas the highest company had 100%. Then the quartile one means 25% of the 60 companies had somewhere between the negative 81 to 33.6%. The median is 50% of the companies out of the 60 had between 81 to 39%, and so on. Quartile 3 means 75%. And what I do this, why I collect the data, is I need to get a sense of the industry. Because remember, I'm going to take these metrics or these profitability ratios and I'm going to input them into my valuation. So if I don't have a sense of the profitability ratios within that industry, then my valuation could blow up and it will not be credible. So that's why I collect that data. But let us gauge that data further. And we could see here Celsius at the bottom had 50%. So they had above the median gross margin. If we look at the EBIT margin, Celsius also had higher EBIT margin than the median. Same thing for return on invested capital and same thing for return on equity. So you could say that Celsius is a company, is an outlier that has stronger profitability than the median. But so if we could put this in perspective, uh, Celsius now acquiring Alani NU will have a consolidated revenue around 2 billion, whereas Monster has currently a revenue of 7 billion, so a much bigger company. If we look at the profit margin of EBIT, Celsius has currently 17%, whereas Monster sits with 27%. So it's a much more profitable company than Celsius. But before we dive into the valuation, there's one thing I just want to discuss, which is the mergers and acquisition strategy. As you know, you could grow as a company, you could grow organically or you could grow through merger and acquisition. If I told you that merger and acquisition is the worst strategy of them all when it comes to creating shareholder value, and the simple reason is that many companies tend to overpay for the target company. Let's just take, for example, Celsius and Alani NU. Celsius bought Alani NU for 1.8 billion. Now let's assume that Alani is only worth 1 billion. Net present value is a negative 800 million. That is something that will be taken from the shareholders' pockets out of Celsius. That will be the destroying shareholder value of around 800 million. Don't take my word for it. Let's look at what McKinsey, they did a study and compared the different growth strategies. And you can see here at the top that new product market development was a positive shareholder value strategy. Expanding to different markets was also a positive shareholder value strategy. But the worst of them all, which was negative, was the acquisition. And simple fact, because companies tend to overpay. Let's look at what happens to the stock price. Here on the right-hand side, you can see in red, it's the target company stock price, whereas in blue, it's the acquiring company. And on the announcement of the acquisition, the target company tends to rise, whereas the acquiring company stock price tend to decline. And here again, you can see that perhaps it's the market that is anticipating that the acquiring company is overpaying for the target company. Before we dive into the valuation, I just want to say that this is not financial advice. It's always risk in investing in stocks because stock prices can both go up and down. For us to value Celsius, first of all, we need to understand the mergers and acquisition transaction details. So here we see that Celsius will acquire Alani NU for $1.8 billion, and that will be financed through a share issue of 22.5 million shares in Celsius that will be given to the founders of Alani NU. And of course, that will dilute shareholder value for Celsius shareholders. This is something that we need to consider in our valuation. The second tranche will be taken from Celsius cash balance. So they will use that $375 million. They will borrow money of around $900 million. And then there's a caveat of $25 million that will be given to Alani NU founders based on the company's performance 2025. And all of that equates to $1.8 billion. But here you see that there's a deduction of 150 million in tax benefits. So what happens is that now when Celsius acquires Alani NU, both balance sheets will be consolidated into one balance sheet. And what I understand here is that Alani NU has 150 million in tax assets. Now Celsius will be able to use that and offset future tax deductible operating income. And that's why they have decreased that and said, hey, this is something that we will not pay for, that will be used for us. And that's why we are deducting that from the acquisition price. Now to the right, we could see Alani's NU EBITDA for 2024 was around 136 million. So they're acquiring the company for around 12 times EBITDA. From a consolidated perspective, we could see now that Alani plus Celsius will have a revenue of 2 billion, as from previous year where Celsius was a standalone company, it only had 1.4 billion in revenue. And as a combined company, EBITDA will reach to 393 million dollars. And Celsius is saying that they are seeing some synergy effects with the acquisition, that they will be able to drop costs down by $50 million. And that is something that I also taken into consideration in my valuation. Now, going to the free cash flow valuation. Celsius will have a revenue of 2 billion now when they acquired Alani NU, and they will grow in line with the market for next year, which is 10%. And after that, they will be able to grow at the rate of 15% in 5 years. Until then, the revenue growth will decline down to the risk-free rate. Because remember, you can't grow in eternity higher than the risk-free rate. Then in other words, you're growing faster than the entire economy, which is unrealistic. The operating margin will improve from 19% trailing 12 months up to 20% next year. And the reason is Celsius mentioned about their synergy benefits of acquiring Alani NU and decreasing their cost by 50 million. However, though, I think that the profit margin will decrease down to 19% in year 10, and this is due to the market is really saturated with energy drinks. The competition is really high, and I don't believe they could reach the margins to what Monster has. And remember, Monster began before Celsius, so there was lesser competition back then. Then what I do, I multiply the operating margins with revenues, I get the EBIT, and then I reduce for reinvestments, what they need to invest in capex, working capital, and I get the free cash flow. I take the free cash flow, I discount that back to present value, and I get an enterprise value of $8.9 billion. As free cash flow is pre-debt, we also need to do some cleanup now that we have the enterprise value. So we have an enterprise value of $8.9 billion, but now that Celsius have acquired Alani NU, I need to increase the debt with 900 million plus the 25 million earnouts that could be given to the Alani NU founders. So that is something that I've added to debt. And that is something that you will not be able to see in Celsius Q4 financial report because they haven't yet acquired Alani NU. Then preferred stock, I deduct $824 million. And if you're wondering what that item is, well, remember when I told you that Pepsi acquired 8.5% of Celsius? That stake I treat as a debt because either Pepsi says, hey, we want our money back, give us the $824 million back, or we convert it to common shares, and that will dilute shareholder value. We'll have more shares. So, I could be more specific and treat this as a convertible debt where, it could be I'll deduct some of it from the equity and then I'll deduct some of it from the debt portion. But, it won't make much of a difference to the value. So I'm just treating it as debt to keep it simplistic. Then cash, if you look at the Q4 statements of Celsius, they have around 900 million. But remember, they were about to pay 375 million of their own cash to finance the Alani acquisition. So I'm deducting that, and then we'll have a net cash of $550 million. Then I get an equity value of 7.6 billion. So now I've done the cleanup. There's one final thing. There's something called option value. And what that is that's incentives that employees get working at Celsius. So instead of getting salary, you could get an option. And that option means that in near future, you could convert that option to shares, and then you have a predetermined price that you could purchase Celsius shares. What happens when those get converted to shares is that the share amount in Celsius will increase. So I value them using a Black-Scholes model, and that value I'll deduct from the equity value. That's the reason you see here minus 51 million. Now I have done the cleanup and we have an equity value of 7.5 billion. But we're not done yet. Remember, in that transaction detail, and I can go back to it, says that they were going to finance the deal by issuing new shares of 22.5 million that they will give to the Alani NU founders. And that is what I'm doing here. I'm increasing that share count by 22.5 million. Then I have a total of 257 million shares. And I divide the 7.5 billion in equity value with the shares, and I get an equity value of $29. So here you have it. We arrived at a value of $29 per share. What we did was we combined both companies, Alani NU and Celsius, free cash flow. We discounted them back to present value. And then we got the enterprise value of around $8.9 billion. But we weren't done yet, right? We needed to do some cleanup because free cash flow is pre-debt. We reduced the debt that Celsius would borrow to acquire Alani of around 900 million. We also increased the share count because Celsius will increase shares by 22.5 million in restricted stock units that they will give to the Alani NU founders. And then we arrived at the equity value of $29. However, though, you might not agree with my assumptions that I made to the valuation, because in my terminal year, I chose 19% EBIT margin, much lower than Monster's 27% EBIT margin. The revenue, I said that they will in terminal year they will come up to 6 billion, whereas Monster has 7 billion. But if you disagree with me, which is totally fine, and again I might be wrong, I don't have a crystal ball, we could run a Monte Carlo simulation, because that will enable us to run different simulations using different assumptions. Like, we could run one simulation with, say, that they would be able to have a profit margin as Monster with 27% profit margin. Then they would have a much higher value than $30. And if we do this 10,000 times with different simulations, I could get a distribution, a normal distribution of values. And then I can tell you that the likelihood that the stock price might go to. So here in this Excel file, I have chosen a uniform distribution for revenue, where minimum the revenue would grow in line with the market at 10%, or maximum at 20%. And the uniform distribution, what it does, it takes the minimum plus maximum divided by 2. So this is the mean, around 15%. Cost of capital, I chose a normal distribution with a standard deviation of 0.5. So it could go up and down by 0.5 in standard deviation. EBIT, I chose a triangular distribution where minimum is 10%, likeliest is 20%. This is my base case valuation. Maximum is 27, which is equates to having a profit margin as Monster. So a triangular distribution looks like a triangular, where you have the likeliest value at the top. To the left, you have the minimum. To the right, you have the maximum. And remember, these values here, where I took minimum, maximum, and I also did the minimum and likeliest and the maximum, I didn't take this from thin air. I actually took that from the energy drink industry, because that would make my Monte Carlo simulation more accurate. You can't just pick and just put here like 40% or 50%. This is not a tech industry. It's not Google. This is energy drink. the energy drink industry. But look now what happens if I press show samples. You see that the value changes. Now we have 90%. This is my base case valuation, right? 15% revenue growth. I press show samples again. I get a different value. Why? Because revenue has dropped. Standard cost of capital has increased. So if I click this button 10,000 times, I get a value of distributions. So let's try this out. I'm going to choose 10,000 simulations and I'm going to press run. And here we have the results of running the simulation 10,000 times, the output from the Monte Carlo simulation. And here we have the different scenarios. So, for example, if you would believe that Celsius would be able to grow at a revenue 20% annually for 5 years and reach a profit margin like Monster 27%, then yeah, the stock price would be valued at $68. And the percentiles here to the left is the likelihood of overvaluation. So if the stock price sits at $68, then the likelihood of that being overvalued is 100%, because this is based on my base case. Remember that. That's why you see my base case in the median value. Here you see my base case, 15% revenue growth annually for 5 years, and then dropping down to 19% profit margin. Then the stock would be valued at $29. The likelihood of that being overvalued is 50%, and 50% being undervalued. In contrary, if the stock price sits at $22, then the likelihood of that being overvalued is only 10%, and 90% likelihood of that being undervalued. So in summary, what caught my attention about Celsius was PepsiCo bought a stake in the company and they acquired 8.5% of Celsius. My thesis was that PepsiCo in the near future would buy the entire company and would pay a premium over the share price. And we then, as investors, would profit out of the acquisition. But now when Celsius have acquired Alani NU, it might have made the ownership structure in Celsius a bit more complicated. So I don't know if the likelihood now of PepsiCo acquiring the entire company of Celsius is higher or lower. But what matters is the value per share. And you saw me value the company, and I got roughly a value of $29. But if you believe that Celsius can continue expanding market share and improving market margins as Monster, then the value per share should be higher than $30. But if you are a bit more conservative, as I am, then the value per share should be roughly $29. And I might buy Celsius if I see the price going lower, down to the $22 range. And the reason is because I know that Pepsi has the right to convert their preferred shares into common shares at a strike price, $25. So if I buy the share price at $22, that's lower than Pepsi's right to buy the shares. That gives me, you could say, a floor. Ultimately, whether you invest in Celsius depends on your risk tolerance and growth expectations. On my Patreon, I share exclusive in-depth stock reports, real-time portfolio insights, and members-only Q&A sessions where I break down the latest market opportunities. If you subscribe, you'll get access to behind-the-scenes content, early video releases, and special deep dives that I don't post on YouTube. By joining, you're not just only supporting the channel, you're getting access to premium research that can help you stay ahead of the market. And the best part, you can interact with me directly and request specific stock analysis that matter to you. If you want to level up your investing journey, click in the link's description and join my Patreon today, and let's build wealth together. What do you think about Celsius? Do you believe that the stock has more room to run, or is it overpriced at these levels? Let me know in the comments. If you found the valuation helpful, don't forget to like and subscribe and hit the notification bell. More deep dive stock analysis. Thanks for watching, and I'll see you in the next one.